There's a comforting lie that tens of millions of employed people tell themselves, "I've got life insurance through work. I'm covered." It's the insurance equivalent of assuming the building has fire exits without ever checking where they are. Your employer's group life insurance is better than nothing, but in most cases it is not enough. Today we're going to show you exactly why and exactly how to close the gap. This is PolicyWise, insurance explained honestly. Let's start with what you actually have. Most large employers offer group term life insurance as part of the benefits package. The coverage is usually free or low cost for a base amount, typically 1 to 2 times your annual salary. So if you earn $70,000 a year, you might have $70,000 to $140,000 of life insurance sitting quietly in your benefits portal right now. Some employers offer you the option to buy supplemental coverage, additional multiples of your salary at a group rate. If your employer offers this and you haven't signed up, that's worth examining. But here's where the cracks start. The first problem: 1 to 2 times your salary is almost certainly not enough coverage for anyone with dependents, a mortgage, or debt. If you run the DIME formula from our last episode, debt, income replacement, mortgage, education, most families with kids and a home need somewhere between 8 and 15 times their annual income in total coverage. 1 or 2 times your salary barely covers the debt bucket. You are likely significantly underinsured if your work policy is your only policy. Problem number 2, and this one surprises people every time: your employer's life insurance is not yours. It belongs to the employer-sponsored plan. The day you leave that job, whether you quit, get laid off, retire, or the company folds, your coverage ends. Maybe there's a brief window to convert to an individual policy, but those conversion options often come at expensive rates with limited coverage amounts. For anyone who might change careers, go freelance, take time off for caregiving, or start their own business, that's most people at some point, treating group life as a permanent plan is a mistake. Problem 3 is the sneakiest one. Right now, maybe you're healthy. You have group coverage, and getting individual life insurance would be cheap and easy, but you're not doing it because work has you covered. Then something changes: a diagnosis, a chronic condition, a serious illness. Now you want to buy individual coverage, and either you can't qualify, or you can only get it at rates that reflect your new health status, which can be dramatically higher. The irony is the cheapest, easiest time to buy life insurance is when you're young and healthy and feel like you don't need it yet. The group policy has been quietly preventing you from doing the smart thing. Problem 4 is your life grows faster than your benefits. You had 1 kid when you started this job, now you have 2 kids and a bigger mortgage and aging parents you help support. Your employer's policy still says 1-time salary. Nobody on HR automatically bumped your coverage because you had a baby.
Here's a nuance worth adding. Many employers offer voluntary supplemental life insurance, additional coverage at group rates. If yours does, that can be a genuinely good deal. Group rates are often competitive because the insurer is pricing across a large pool of people, not just you individually. And many plans let you elect supplemental coverage up to a certain amount without a medical exam, called guaranteed issue. The caveat: even supplemental group coverage still has problem number 2. It still goes away when you leave. Think of it as a cost-effective supplement to individual coverage, not a replacement for it. So what's the right move? 3 steps. Step 1. Find out exactly what you have right now. Log into your benefits portal. Look up your current death benefit amount, who's listed as beneficiary, and whether supplemental options exist. Step 2. Run your actual coverage need, the DIME formula or a similar calculation. What's the gap between what you need and what your employer provides? Step 3. Shop for individual term life coverage to fill that gap. Individual term coverage is portable. It moves with you when you change jobs, start a business, or retire early. Lock it in while you're young and healthy. Once it's in place, your employer's policy becomes a nice bonus on top of real coverage, not the whole plan. This matters to almost every employed person, but some more than others. If you're an employee in your 20s who thinks, "I'm too young to need extra insurance," group life is silently letting you procrastinate on the cheapest window to buy. If you're a new parent who has a child now depending on you, 1 to 2 times your salary is almost certainly not enough. Run the numbers. If you're self-employed or a freelancer, you likely have 0 group coverage, so none of this problem applies. But make sure you have individual coverage. If you're thinking about changing careers, going back to school, or starting a business, your current group coverage has an expiration date you haven't thought about. If you're approaching retirement, when you retire, your employer coverage goes away. Make sure you have a plan for what replaces it. The 4 problems with relying on employer life insurance: it's probably not enough coverage, it disappears the moment you leave, it stops you from buying individual coverage while you're still healthy and cheap to insure, and it doesn't automatically scale with your growing life. The fix is straightforward. Know what you have, calculate the real gap, and fill it with portable individual coverage. Next up, the part of life insurance nobody talks about until it's too late. What actually happens after someone files a claim. The process, the delays, the reasons a claim can get contested, it's all in the next episode. That's coming up. Subscribe for one honest insurance breakdown every week. This is PolicyWise. General education only, not financial advice. Talk to a licensed professional before you buy.